Let's take a look and see how much that sells for. Whoops, I'm not going to buy the vertical. We're going to buy the straddle. Straddle is about $2 for the August expiration. And so how do we determine actually whether that's a good price or a bad price? Well, one thing that we want to do at all times is take a look at the implied volatility. It's at 42%. Is that high or low? It could be high, it could be low. We really don't know. If we take a look at the stock itself, we notice that it has been in a downtrend. However, it has traded sideways for quite a while, which has helped to reduce the volatility in the issue. The one thing that we want to do for sure, though, is to go over to our trade tab. And this is how we'll be able to determine whether or not this is a good issue to trade. We're going to use 10 contracts in this example at $2 a straddle. Now, as you can see, if we purchase the at-the-money straddle, which is the 26 August expiration straddle, we have a delta starting out at about 29 or 30. Positive deltas. That's fine. That's not very much. That's actually a pretty good number. That's relatively delta neutral. The one thing that we want to do, though, is be a little more scientific in our selection of the stock. So what we want to do is take a look at the probability analysis tab in our thinkorswim platform. And what that does is give us an idea of the stock price volatility, which is 39%, over the next 20 days. In other words, what we want to do is take a look at what the volatility would determine is the probability of the high and the low of the stock price before the August expiration, because we are trading the August expiration. Well, the greater the range that we can capture profits in, obviously the more successful we're going to be in gamma scalping this particular issue. We can also determine from this analysis chart what effect volatility is going to have, whether increasing or decreasing on our position, on our straddle position. Because remember that we're fighting against theta. I mean, the one thing that we really want to have is a very large range in which the stock price can move in order to profit from the fluctuations. All the time we need to consider the fact that we need to make more than the amount that we're losing based on theta decay. In this particular issue, the theta at the current price is minus $47.69. That means for each day that goes on without the price moving, we will lose $47.69. If we take the date tab here and just simply increase the date, you can see that theta does increase. Oops, I got to increase it. Theta at $40.85 increases each day as time passes and decreases our profitability by the exact same amount. So each day that passes, theta is recalculated, and it as long as the price does not move, we will lose that amount in theta for each day that passes. Let's go back to our current date. The same thing with volatility. Volatility is another problem with gamma scalping, and it's certainly something that we want to take a serious look at. With Vega at 47.57, it means that we can adjust volatility in our analysis tab. If we were to decrease volatility, you can see that we will, by 1%, we will decrease the amount that we make on this position by exactly $47.50 for each percentage of volatility. If volatility were to increase, we would make that amount in additional profits on our straddle. An additional 1% volatility will increase our profitability by $47.64. So as we do our analysis of different issues that we're considering doing the gamma scalping on, we need to consider carefully the Vega position. That is one of the most important Greeks as far as gamma scalping go, because as volatility increases, we make money. If volatility decreases, we lose money. So it just makes sense that we don't want to buy issues that are at the high range of their historical volatilities. We want to buy them in the low to mid section of their volatilities. And the way we can determine that is simply to go over to our profit charts and determine exactly where the volatility of this particular issue is. If we go over here and put in JNPR, I have already called up historical volatility, but you can go into, let's see, I'll do another study here. And then what I'll do is just to show you how this is set up, I'll go into my studies, go to apply studies, and in the left hand box here, all you have to do is scroll down until you get to historic volatility. Just take that and drag and drop it right into your window, and it will automatically call up the historical volatility. Now, would you say that Juniper Networks is in the lower end of its historical volatility? Would you say that it's in the high end of its historic volatility? Or is it in the middle of its historic volatility? Well, it looks like it's kind of close to the upper end, upper range of its historical volatility. And we already showed in the analysis tab that if historical volatility decreases, it comes down from these levels. If it goes down by 1% from its current levels, then we actually lose money on the position. Because we are long calls and long puts, we're going to have a positive vega on this position. So let's go back to the profit chart for a second. Now, considering that this is at the higher end of the range over the past 5 years, this is a 5-year daily chart. We want to take a look at the long-term view of the historical volatility. And if the volatility is at the high end of the range, there's a possibility that it could go up a little bit higher. But guess what? We're more likely to come down from this level, because if we take a look at the historical volatility, we can see that it has decreased each time that it's gotten very close to this level. So the probability is that it will decrease rather than increase, and that will hurt our position. Now, there are several factors that besides volatility that help to make this a good candidate for our gamma scalping position, and that is the fact of the price of the actual at the money straddle itself, the range in which it can move, the current stock price, the historical volatility, as we mentioned. And if we put those all together, we can come up with a fairly objective analysis of each of the issues that we're considering. Now, you can, as I mentioned, you can get your list from any place that you like. You can go into your, you can have your own watch list set up. You can go into the TOS tab here for index details, and you can take a look at any of the ETFs, the Dow. You can pretty much select any issue that you want, as long as it's liquid, as long as it's trading at least 1 million shares a day. I would probably say closer to 2.5 million to 5 million shares a day. You're probably better off on the issues that trade a larger number of shares, only because you're going to have a better bid-ask spread on the options themselves, as well as more liquidity in the stock. So you can pick any issue that you want. You can go into a newspaper like the Wall Street Journal, the Investor's Business Daily, and you can select stocks that you see that are in the news. And then once you get a kind of a short list together, you can take a look at it and plug it into a spreadsheet that I prepared for you, which is proprietary to Tradingology, and it's for your use only. And I'll let you take a look and see exactly what this looks like. But basically all we have to do is take a look at certain variables in the stock that we're considering to doing the gamma scalping with. We're going to be taking a look at several issues, and I'm going to be adding issues down at the bottom here so that you can get an idea of exactly how to enter this information yourself. You will have a copy of the spreadsheet in this folder with the video.